Federal Reserve's economic projection seems to be unreliable based on what we can observe so far in 2024. In the beginning of the year, the Federal Reserve was projecting 3 rate cuts this year, and right now they're trying to put it on hold. In a recent event, current Federal Reserve Chairman Jerome Powell attended. He suggested that delaying interest rate cut due to persistent inflation, and indicated that policymakers need more time to assess the situation. This is because consecutively hotter than expected non-farm payroll numbers and the CPI inflation reports. He has also emphasized the need to allow the current policy to work and stated that the Fed can maintain its current interest rate for as long as necessary. His speech had a major impact on the market's expectation of the future rate cut. In the beginning of 2024, the market was expecting 6 25 basis point rate cuts throughout 2024, which is 1.5% interest rate cut in total. And right now, after Jerome Powell's speech, that number came down from 6 to 1 25 basis point interest rate cut happening in September. Along with the changes in expectation, we also see 2-year Treasury bond yield going up to almost 5%, rising from 4.1% in the beginning of 2024. So it shows that the market is expecting higher rate for longer because 2-year Treasury yield reflects market's expectation on how high the interest rate will be on average in the next 2 years. Former Fed Chair Ben Bernanke, he was Federal Reserve Chairman from 2006 to 2014. And I call him the father of quantitative easing in U.S. He is not the father of QE in the world because I believe Japan is the first country started using QE, but he is the first one to implement that in U.S. For the 2008 great financial crisis. So Bernanke, he recently wrote a report for Bank of England. It's an independence review report for Bank of England's methodology on forecasting the monetary policies. And I think his report also applies for Federal Reserve because currently they kind of use the same linear forecast method. In his report, Bernanke suggested that central bank should incorporate what he calls scenario analysis to communicate a range of potential outcomes more effectively. This approach will offer better insights into policy decisions and better transparency, particularly in volatile economic conditions. Now, his report is super long, right? But I summarized his proposal in this one chart, where the top half of the chart shows you the existing forecast system of a central bank, and the bottom half is Bernanke's proposal. And let's go over the existing system, what he called a central projection. So I'm going to use Federal Reserve as an example. So at every single FOMC meeting, the policymaker gathered together to assess whatever data that has been coming in since the previous FOMC. So you have CPI, PPI, you have non-farm payroll, you have retail sales, you have PMI, and blah, blah, blah. So based on all the economic data, they're going to project a monetary policy. So this happened in the form of dot plot every other meeting. So dot plot, every single dot shows a policymaker, and from the dot plot you can kind of feel where the policymaker are going with the interest rate, and based on their proposed interest rate, the policymaker is going to project a economic forecast. They're going to tell you what they think 1 year later the GDP will be, what's going to happen to CPI, unemployment rate, and so on, blah, blah, blah. This is the linear approach of the central banks, the existing method. And this bottom half is the proposed method by Bernanke using scenario analysis. And as we can see, you go to each meeting, it's happening the same way, right? You assess the incoming data, but this red portion or stage is something new in his proposal. So in this approach, you're going to combine with the incoming data with different scenarios that can happen, that could happen in the future. For example, scenario number 1 would be oil price go up by 20% due to geopolitical issues. And then that's going to result in high inflation plus high growth. Plus low growth. So this is what we call a stagflation. And you may combine your current status with scenario number 2. It could be due to resilience of the economy, we have high inflation plus high growth, right? And then you can combine that with something else and you get maybe a 5 or 1% chance of a recession, right? So you have that's your scenario N, right? You have multiple scenarios in between, right? And then for each scenario, you're gonna propose number of different policies, right? Maybe policy number 1 could be keep the interest rate for a year. It's stable for a year. Policy number N could be at 5%. Keep it at 5%. Another policy could be keep it at 4%. Or maybe you're going to combine that with a quantitative tightening adjustment, right? You QT at a slower pace or whatever. So every scenario would have multiple policy projections, right? And then each policy projection will be associated with a economic forecast, right? Your policy 1 should give you a forecast of outcome number 1. Your policy N give you outcome number N. Same thing for every single one of them, right? This is the new method that Bernanke, at least that's my understanding of what Bernanke is proposing. So let's go over the benefits of this new proposed methodology or approach, right? With this approach, I think there's a number of benefits, right? It enhances the decision making, where this approach allows policymakers to compare potential economic outcomes based on different policy strategies under different conditions and scenarios, right? It helps the policymaker to choose a policy that best align Federal Reserve's current mandates or long-term goals. For example, if this does happen, right, there's a number of policy to choose from. And how do you choose that? You look at the number of projected outcomes. Which one meets your long-term goal? So currently, Federal Reserve have 2 mandates. Long-term mandates. Number 1 is maximum employment. Number 2 is financial stability, right? You pick the outcome, you work backwards, or you pick the outcome based on your long-term goal, right? And another benefit of this approach is it helps Federal Reserve to manage risks, right? By considering this new stage, right? Different scenarios. Because now, even though there's let's say a 0.01% chance of a recession in 1 year, but at least your model, you considered it, right? So making them prepared, right? And since they have this framework set up, at every meeting, they can just adjust this framework or model based on whatever is happening in the globe. It could be a geopolitical progression or whatever. They can adjust their model accordingly every meeting, right? And as a conclusion, I think this model is very interesting, and I think I kind of like it, right? Compared to the traditional approach. Of course, this new model involves a lot of extra work for the policymakers. They have to work harder on it, but it provides transparency for the public. If every other meeting they provide this framework to us, so we know under each scenario what they're proposing. Right? It's a lot of transparency, but the policymaker may not like it, because having that transparency open them up for criticism or attacks, right? Because people can look at their model and make criticisms. Nobody likes criticisms, but from a system point of view, it's not a negative thing. Having criticism can be served as a feedback mechanism to help the policymaker to improve their model. So as a conclusion, my preference goes to the new system. The old system is way too simple, way too linear. It does not get the job done well enough, because policy making for monetary policy is a very sophisticated process. It takes a lot of thinking, right? And the thinking happens here and here and here on the new system. It's sophisticated enough. It's no longer reactive like this guy. It's now proactive, anticipatory. Thank you very much. Please subscribe to my channel.